Okay, folks, looks like it's the top of the hour. My name is Jeff Clark. I'm with Regional Director here with GoldenCare USA. I always like to kind of do a little introduction on myself before we get started on this. I've been working with GoldenCare for 25 years. The first 5 years I spent as a sales rep, field agent. I wrote a good bit of long-term care. It's the main thing I did, I guess. I kind of started with long-term care, and I eventually learned med sups and annuities and things like this, burials. And so, a little more unique that I started on long-term care. A lot of people add long-term care after other products, but so I guess I've been in long-term care for 25 years now. I've been with GoldenCare for 25 years. So, the first 5 years in the field, the last 20 years has been my job to really basically train and recruit and help agents with, product stuff. And so on a daily basis, I'm basically breaking down different long-term care plans, home health care plans, short-term care, based on the clients that, an agent might bring a married couple who's very healthy, in their 50s, or maybe a 71-year-old widowed lady with osteoporosis. So it's my job basically to kind of go through different plans, design some plan options, help them with the best thing based on what the client you bring me. I kind of help you find the best plan for that. So today we're talking about Mutual Omaha long-term care plan, which is, let's face it, it's the cat's meow as far as the long-term care industry. There's not a lot left on the table. 10 short years ago, there was over 100 companies selling long-term care. Now we're down to, of course, about 3 or 4 that you can actually broker. But Mutual Omaha in that arena is the king. Best benefits, the most flexible benefits. The two things I take away from this thing is, first of all, the strength of this company, but that this product itself is probably one of the most flexible plans that you'll find out there. You can basically tailor it to exactly what your client's looking for, more so than other plans. It's got a lot of flexibility, and I'll show you that as we go through. The second thing to take away from today is Mutual Omaha's strength of their home care. So, I always kind of tell people when you're looking at long-term care plans and comparing them, the Mutual Omaha plan has such strong home care benefits that if you look at, Thrivent or NGL or the federal plan or the other plans that are offered out there, the facility is the facility. If I sign on for a monthly benefit of $3,000 a month, and it's going to pay me $3,000 a month, whether it comes from Hancock or if it comes from Thrivent, NGL, or Mutual Omaha. Where the plans really separate themselves is how they handle the home care, whether or not they pay a cash benefit, whether or not there's a calendar day elimination period versus service day. So with 80% of claims starting in the home care arena, I really do feel like the home care area is an important area, and Mutual Omaha has the strongest home care package of anything out there. So that's one of the reasons why I do think it's the best plan out there. It's flexibility and its strength of home care. So just if there's only two takeaways from today, remember those two things. Very flexible product, it's called custom solutions, so you can customize, but also the strength of home care. I have a PowerPoint, and then and I haven't done this particular presentation for a long time, so I'm probably going to do this a little less traditionally than going through a PowerPoint. I'm just going to go right into the software and basically explain this to you. So flexibility, home care, I've kind of talked about that. Mutual Omaha is a big name. I think we all know who Mutual Omaha is. Number 2 in national sales and med sup. The name resonates with the senior population, and most people know who Mutual Omaha is. Couple changes that happened the last year and a half. There's now a 25% cash benefit versus the old 40% it used to be. We just go with higher daily amounts now, or higher monthly amounts, and lower inflation, so we kind of get around that. And the other thing is they changed the discounts. Where's that at here? So cash benefit is 15, then here we go. Premium allowances. Okay. The other change here is that it used to be a 35% discount for both married, both insured, or excuse me, 30, and then it was 15 if only one got accepted. Now it's 15 and 5. So other than that, a lot of these things here, I'm just going to go right into the software to kind of show you these. We'll talk about the different optional benefits that are there, built-in benefits. I'll go through the shared security joint waiver on the software here. So let me, the speaks to flexibility. Let me bring that software up. Okay. So, and I don't know if I even blow this up, I don't think it makes it much of a difference here. Yeah, it's still gonna be just that. If I'm gonna design a plan, the first thing I'm gonna do here, and I don't know how much you use this, but you can put your client's name in over here. I don't know, we'll just do Joe bag of donuts. And we'll do Carol bag of donuts. Carol donuts. Okay. Put your agent name in there if you want to, your phone number. All right. And so then it's for going forward, you can save them then and do multiple quotes and save them inside the software. Okay. So let's just say I'm going to do a quote. I've got a married couple from Ohio. That's what we're working on. So the first thing I'm going to do here is I'm going to go into Ohio. Now, underneath here, Mutual of Omaha offers two different plans in their portfolio. They're going to offer a custom solutions and the other one's called secure. Now I'll show you this in the software, the difference between the two, and I can tell you why I always use the custom. And the reason for that is if I go to secure, you'll notice a lot of the options kind of disappear. Like now I only have a 90, 80 to 365 in the elimination period. I lose some of my inflation options. So essentially, when people ask me, what's the difference between the two? Well, mainly there's just a lot more options with the custom. It gives you basically everything that Mutual of Omaha is offering in a long-term care plan. This was kind of the secure was made to be kind of simpler, heater and keys, if you will. If I was buying a car, no options. Here's just kind of a stripped down model of the Mutual Omaha insurance plan, long-term care insurance plan. So what I tell people is, look, what you should do is just work with the custom. And the reason is because that way I have all the options that Mutual is offering. I don't have to sell them all. I can basically strip it down and I can make this a secure solutions just by taking all the different bells and whistles out. So what I like about this is you can kind of design and craft whatever you need. So if you learn the custom solutions, you have everything that Mutual is offering. So stick with the custom and don't look back. So let me go through that. So, okay, I'm in the state of Ohio. I got custom solutions. So this is a married couple that are both applying. If it's married one applying, then you get that discount. So then I do this, right? Or if it's a single person. So in this situation, we got married, both insured, male and female. We're going to say this couple is, I don't know, Joe is 60. Joe Bag of Donuts 60. Carol Donuts is 55. All right. I quote everything at select. Okay, and the reason that is the preferred health discount. Let's just make sure that that's a 5% extra on that. Let's take a look at that. First 15%. Partner one issued 5. Partner both issued 15%. So I can tell you that when I'm running these, some 85% of the business, close to 90% of the business is issued at select. Talking to an underwriter at Mutual a couple years back, he told me that only 8% of business is actually issued at preferred. So, and there's only 5% that's issued at class 1 or class 2. Like they have a health condition where they're actually going to rate them up. And that's 25% higher or 50% higher for class 1, class 2. But again, about 85, 80, 88% of business is issued at the select. So I would suggest always using select. Unless they tell you they run marathons, height and weight's great, no meds, just I don't mind quoting preferred if someone asks me to. I just prepare them for it that it's not as easy to get. But okay, so I'm gonna do select. Now again, call this maybe a sales tip, pearls of wisdom. So if I'm designing my monthly benefit here in this option here, I can do anything from 1,500 up to as much as 10,000. Now, as you're designing a long-term care plan, I've often said this over the years, it's not as hard as people make it out to be. There's really 3 things you need to know to sell long-term care: how much, how long, and how soon. That's the first 3 things we're going to put in this. And this is basically the nuts and bolts. This is the main part of any long-term care policy, is how much per month am I getting? How much total am I getting? So how long will it last? And how soon do I start getting it when I need it? If you can figure out these 3 things, you can sell long-term care. Okay, the rest of them are just kind of, riders and bells and whistles, and I'll go through those. So, but when you're designing a monthly benefit, and this is just my advice to you for someone I've written, I don't know, 800 in some of these policies. It seems like with the prices now have gotten higher than that was 10 years ago. They're figuring out basically how to the underwriters, the actuaries know how to price this policy, so you don't have the rate increases we used to have. They understand, they've got claims experience. So the prices, the way they are higher, a lot higher than they were 10 years ago. So I've had to shift how I go about quoting my my customers, what kind of plan designs I'm helping. So when an agent calls me, I'm very conscious to tell them, look, work with your client. Your client may have, a pension income of a couple of grand, a social security income of a couple of grand. Maybe they got some dividends coming off their stocks, whatever other income they may have. What we're trying to do with long-term care is we don't want to touch the principal of these investments. So maybe they've got an income of about $4,500 already. And if you go to a facility, you're not necessarily going to have your house bill, your electric bill, so we don't necessarily have to have the long-term care plan pay all of the bill. And that's a mistake a lot of people make. If I find out my local nursing home here, I'm in Minneapolis, but I don't know if I'm on the Eastern Seaboard there, if I'm in Virginia, or if I'm in Pennsylvania, and I'm in, Philadelphia looking for care, the care out there might be all of $9,000 a month, right? And so people will go ahead and they'll do $9,000 then a month for a benefit. And then, you could be in there for, up to, I knew someone once that was there for 7 years. Well, that does happen, but so they're going to do a $400,000 pot of money, 450, right? Now this couple, right, look at their premium, $12,563. You're not going to have a ton of luck quoting numbers like that. So what I kind of tell people is, look, your income, what you're thinking about with long-term care is, I'm going to co-insure here. I can afford, okay, if the nursing home bill is going to charge me, the assisted living facility, if the home care that's coming out here is costing me like $5,000 a month, I have $3,000 to $4,000 a month, of leftover money. What I need is probably an extra $2,000 or $3,000 to cover me for home care. If I end up in a nursing home, I might need an extra $4,000 or $5,000. So I might start this out then at, $4,000, $3,500, knowing that they're going to subsidize or co-insure this. Trying to sell the whole ball of wax anymore, just too hard. It got the insurance companies in trouble. Clients are paying a lot of money. So also, the average claim, 90% of claims don't go beyond 2 years. So I don't mind selling a little pot of money of 100,000 to start. Okay. And then with inflation, I'm okay with doing 2% or, lower inflation. So now if my first quote I'm going to show this couple, the 60 and 55-year-old, is going to be $2,885 annually, right? So monthly of $259. I don't want to start out quoting them a $12,000 annual. So talk to your clients. When you do these three things here, how much? Again, I can pick 4,000. Maybe I'm going to show them, one benefit of $4,500 a month. Another one with $150,000 pot of money. And then the third option might be a $6,000 a month benefit, if they really do feel like they have some money. And, so, my quotes are going to kind of vary between, for a married couple, $2,500 a year annually up to about $5,000 annually. And naturally, if they have a lot of money, or you'll know when to get, a bigger policy. But I would just argue you need to keep these down a little bit to start with. So how much monthly benefit? You pick anything from 4,000 to from 1,500 up to 10,000. I'm going to do 4,000, for example, for my first quote. I'm going to do a pot of money. How long? So if I use $4,000 for a month, how long will $100,000 last me? Well, if I go right to the facility, I don't pass go, it's going to last me 2.8 years. But what if I'm getting, what if I'm in the home getting care? Like I mentioned earlier, 80% of claims start at home. So what if I'm at home and my wife's kind of taking care of me? The neighbor kid's been mowing the lawn, helping us out, maybe shoveling the driveway with snow, or, my daughter comes over and helps us with groceries, or, so I've been on home care, but I'm not really getting the full facility care. I'm not in a nursing home. I'm not having professional. So how long will this, if I'm at home care, will this last? Remember, I have $1,000 cash benefit that's built in here. So if I have a $4,000 a month, remember 25% of that benefit is in cash. So matter of fact, I'll just switch over there quick. Okay. So cash benefit, and this is something, again, this is what, when I spoke about the two things with this Mutual of Omaha plan, flexibility and home care strength. This is one of the big things that makes this plan so darn valuable in the home, is built in here. You get 25% of that monthly benefit we pick automatically in cash at the first of the month. There is no elimination period. So dad has a stroke, mom's taking care of dad. First day, we can mail $1,000 a month to that family so mom can help take care of dad, maybe pay that neighbor kid that's mowing the lawn or shoveling the driveway, or maybe give the daughter some money for gas for going grocery shopping or what have you. It's that cash benefit. It's the informal care that represent 3/4 of home care claims are informal care. 3/4 of the time, it's a family member or a friend that's doing the care. With most long-term care plans out there, they're reimbursement models. You have to have a licensed, skilled, or otherwise, it has to be a licensed nurse or physical therapist or home health aide that works for the agency that's been approved by the carrier to be reimbursed. So it becomes more difficult to get a child, a adult child, or a spouse, and a lot of them have exclusions. They won't pay family members. So what the cash benefit does, I can't tell you how valuable it is. I get claims all the time, almost always, 80, 90% of the time, they take the cash. Because usually after that first stroke or the family rallies around, they try to keep the dad at home. I'm picking on dad here, but they're going to do what they can to keep that person at home. At some point, it might be the point that they have to move to a facility. Hey, great. At that point, if you have to move to a facility, then we're just going to go ahead and we're going to access the full reimbursement monthly benefit. So when people ask me, how long was $100,000 last as far as benefits? It depends on how you're using it. So this pick max button here, this just tells me that if I'm using the cash amount at $1,000 a month, it's going to last me for 8.3 years. If I go right to a nursing home, don't pass go directly to the nursing home, $4,000 a month, well, it's going to last me for 2.8 years or 2.08 years. So when people ask me, how long will $100,000 last me? I'll tell them between 2 and 8 years. Remember that 90% of claims don't exceed 2 years. So selling a little $100,000 pot of money doesn't seem like much, but I'm taking care of 90% of their risk. So how much, how long are two big little swiveling options here. If I want to maybe again go 4,500, I have to leave the person with at least 2 years. So you notice it'll go yellow here. One thing I'll quickly say also about the software, it's such nice software. It's very intuitive. It thinks for you. If you make a mistake, it won't let you quote it that way. So here it's telling me that it has to be at least a 2-year benefit. State law requires that. So I have to go with at least 115,000 if I'm going 4,500 to be able to quote it. So it won't let you quote something that's not available in Mutual Omaha software. So the nice thing is if you see yellow on here, it means that there's something wrong. It doesn't, they don't have that benefit. Maybe you're trying to sell, a 20-year inflation rider or someone who's in their 80s or whatever it is. If it's not available, so this software doesn't allow you to make a mistake, which I really like about it. Okay, so how much, how long? I know I beat that to death, but those are very important. Then how soon? And that's the elimination period. I can go with 0, right? That's going to make it, first day coverage for everything, $4,900. If I wait for 90 days, it's dropping that premium. Most, I would say, I don't know, I don't have an exact stat here, but most of the time, you're always using 90-day elimination periods. Why? Well, typically Medicare is set up to pay your first 20 days in a nursing home or a rehab center. Maybe you've had a stroke or you've broken a bone and you're in the hospital for a couple of days. Well, before you go home, they send you to some type of rehabilitation center, nursing home. The Medicare pays for your first 20 days in that nursing home. Your Medicare supplemental coverage, whether it be a Medicare Advantage or a Medicare supplement, is going to pick up days 21 through 100. So, and that doesn't happen all the time, by the way. But a lot of people then, because they have some coverage, short-term coverage with Medicare, they'll go with a 90-day elimination period. Now, there is this thing here called the home health care waiver premium. Okay. What that says is, if I'm using the 4,500 a month, let's just go back to 4,000, 100,000 just for simplicity here. If I'm using this 4,000 a month, I can't access this till 90 days goes by, just like the facility. So if I do want to have, maybe I want to have access to say whether mom can take care of dad because it's a very mild stroke, or maybe dad had a severe stroke, where she can't lift him out of the bathtub. She can't do the physical therapy that he needs. He needs to do, physical therapy. He has to work with an audiologist to get his linguals back. So there's a lot of, she's going to need to access the care right away, the full $4,000 a month. Well, if she wants access to that for the home care waiver, we can put that on there. Now you'll notice it puts about $500 on there to have access to that home care first day. Now, and I can go back and forth with this. It makes it a valuable benefit. I'm never going to tell people not to sell the home health care waiver. Now, it does put some money on there. And I do feel like with the cash, you already have some help that comes first day built in. So it's kind of rare that you go right to professional care right away, but it's a nice option to have. So whether it is full-time care or basic care, you've kind of got both of them covered first day. Let's try to keep them out of the nursing home. So the home health care waiver does still bolsters that home care. It's a nice option to have. I sell it probably at least half the time, I suppose. Maybe more. Okay. So how much, how long will it last, policy limit, and then when do I start getting benefits, elimination period. Those three things that's true. Okay. Now we're going to talk about inflation. Put this one in the chart of, I mentioned flexibility. You know, the unsurpassed flexibility, this thing, it's custom solutions. Well, look at the inflation. You have a lot of inflation options. I think they even list them here somewhere, right? So notice with the secure solutions I mentioned earlier, you've only got a 3%, 4%, or a 5%. And if you want to do a 20-year time period where it only inflates for 20 years, you can use 3% or 5%. No buy-ups. This is the secure solution. So over here with the custom solutions, you have anywhere between 1 and 5% inflation in 25 point in quarter point increments. So I can go with 1 1/4, 3.75, 4 1/4, etc. And I can do this so it only inflates for a period of 10 years, then stops, 15 or 20. Why would I do that? Well, when people get to their 60s, inflation gets expensive. Average claims happen at 82. So we're trying to curb the cost of the insurance by using the inflation. Plus you have a buy-up option. If I start with 1% inflation, with the custom solutions, I'm able to increase that from say 1 to 3. Maybe inflation is getting away. Maybe inflation is getting away from us. Funny, I haven't done this one for a while, but clearly inflation has gotten away from us. The costs of nursing home are going up, especially with COVID, with all the PPE, the personal protection equipment they need to keep the workers safe, the hazard pay they're having to pay. Nursing homes are going up faster than we've seen recently. So it's nice to have the option then to buy up. In other words, I can go from 1% to 3%, so my policy benefits grow faster. I can do that without underwriting. So, you know, what a huge benefit. You know, so for 20 years after you buy, for 20 years after buying this policy, you have that option to buy up. So that helps me with when I'm quoting someone to explain to them that if they don't really like $3,722 annually, I might tell them, you know what we could do? We could lower this inflation back, you know, like 2% or 1.5%, right? No, that's not going to be a partnership qualified plan anymore. That's what the software is telling you. Big deal. That's another whole topic, but partnership is just, it doesn't mean a thing, to be honest with you. So if you want to ask me why that is, I can talk to you about it, you know, personally, but very, very few, if anyone, actually accesses the partnership benefits. So it's less than 1% of people ever even get the chance to access it. And when they are there, most of them don't. So it's a nice benefit to get you in a house. It sounds good on paper, but in reality it doesn't. So I don't get hung up on whether or not this thing is partnership certified or not, or partnership qualified. Okay. So here, maybe I'll go with 1.5%. If I do this is a 60 and 55-year-old couple. That means that any time in the next 20 years, I'm able to increase those benefits. With the 60-year-old, actually, you can't do it beyond age 76. So for Carol, she can do it anytime next 20 years. She can increase her inflation to whatever she wants, free of underwriting. Joe can do it anytime before his 76th birthday. It's a huge benefit. So I want to start the people with some coverage. Maybe they can't afford that, you know, $4,000, or so I can step them into like $2,500 to start with. You know, can you afford $100 a month each? Okay, because remember, some coverage is better than nothing. We're co-paying. We're trying to find a way to keep these premiums down so you'll sell more long-term care. One other thing I'm going to show you quickly here, the short fat on here, but let me do it anyway. Okay, so Think about the policy maximum. This is a pot of money is what we're working with here. So for example, if I were to do $4,500 a month and I were to do a premium of 200 or a policy maximum of $270,000, you see how that's 5 years then? So $4,500 a month with a pot of money of $270,000, it's a 5-year. We used to hear agents, and we still do, I'm guilty of it, we talk about having a 3-year plan or a 4-year plan or a 5-year plan. It's always kind of silly because remember, this $270,000, depending on how you use it, if you're using the cash benefit, that $270,000 would last you for 20 years. If you went right to the nursing home, it's going to last you 5 years. So this pot of money will last you between 5 and 20 years. Plenty of insurance. Like you're at 99.5% coverage there, so you're really almost over-insuring. But this $270,000, I don't want to have just $150 a day or $4,500 a month for a nursing home benefit, because remember, if I'm in the Eastern Seaboard, if I'm in the East Coast, $8,000, $9,000 a month is pretty common, right? So I might need to have. So I'm going to do this, and by the way, here I'm going to put 5% compound on there. So so at this point, I'm not worried about being okay. It is partial. So that premium, $11,000. And if by growth, by the way, 5% of this $150 a day or $4,500 is going to give me an increase of $7.50 each month. So it's going to bump up at that rate. $270,000 pot of money, $150 a day. If I had 5% growth, if I wanted to be a better designing of this thing, I'm going to do $7,500 here. I'm going to lower the inflation down to 3% raise on the 750 is the exact same raise you get on 5% at 4,500. And then I'm going to take my assisted living down. Okay, so that's 3,750. It was at 4,500. So basically, I have kept this pot of money right here. I haven't changed anything. I just changed how I'm inflating it. And by the way, the 7,500 and this 270 is at their age bracket. The crossover point for these people is like age 85 or 87, where it'd been better off to go with 5%. So in other words, but remember that premium was $11,000. So average claims happened at 83. So I've given this couple more benefit now. I've given them more benefit now and more benefit for the next 20 years, 25 years by doing it this way. And I'll take it a step farther. With today's rates and inflation, I'm not even opposed to going 1% and doing this at 10,000, or just take the inflation all together. So what I'm doing here is I'm pre-putting the inflation on that. Now look at that, 37.76. I didn't change a pot of money, right? Now sure, it's only 225, and if I lower this back to 5,000, well then it goes to 5 years again or everything, right? Don't get caught up on the years. It all depends on how they use it. I am completely okay with selling a $10,000 benefit. Just remember here, we're at $3,700 instead of $11,000. And the crossover point isn't for 30 years. So I'm giving these people a lot more bang for their buck by not using inflation and by going with higher monthly amounts to begin with. Now, I pounded the heck out of this because this is where I see agents make the biggest mistake. This area, my suggestion to you to get premiums down, $10,000 or higher, or 8, 9, 10,000 benefits with lower inflation or no inflation. Okay. All right. So let's go back to how we were here. For sake of argument, we're doing a 4,000 to 100,000. Okay. Lifetime inflation on there, and then we'll just go with 2%. Okay. Pretty affordable premium there, right? You always build up from there. Okay. Assisted living. If you'll notice here, I have the ability. This is the flexibility factor to sell 100% assisted living, 75 or 50. What's the right answer? A lot of people don't like to cut this. Assisted livings are, I can tell you that assisted living is about 13 to 15% of claims. In other words, you got to be sick enough to go into assisted living. And if you're too sick, then I want you to move to a facility, full service, etc. So, I'm okay with reducing that a little bit. Nationally, according to Genworth's cost of care surveys, Hancock used to do them, MetLife used to do them, Mutual Omaha still does these cost of care all over the country. Assisted living facilities charge about 56% of what nursing homes do across the nation. So in other words, assisted livings just aren't as expensive because it's assisted living. You're doing a lot of it. It's your own apartment, it's your own. They're just checking on you, make sure you're taking your meds, they have a cafeteria down on the first floor. You can eat on your own if you want to. So this isn't full care. They're not bathing you, dressing you, feeding you, doctor, all of that comes with it. So you're okay with sometimes maybe taking the assisted living down to 50 to save some premium. And I don't mind doing that because, again, assisted livings aren't a huge chunk of claims. It's 15 to 20% of claims at most. And they don't charge as much as nursing homes. So that's one area I don't mind. And I like having that flexibility. If your client already knows they're going to the Wellstead, the nicest assisted living, it's right down the street here, all my friends are there, it's really expensive, well, then don't cut it. Just keep that at 100%. It's nice to have that option. Home care, same thing. You can cut this down 75, 50. I'm going to stop right there. Never do it. Never cut the home care benefit. Why? Because that's 80% of claims. In other words, I'm not going to cut an area that I know that's 4 out of 5 people are going to use this part of it. I don't want to cut that part. Now, occasionally you have this person that says, I don't want to be at home, Jeff. You know what? If I have a stroke, I don't care if I end up, in a facility because I'm kind of lonely anyways. I hear they have activities there. So if they literally say they don't want to be at home, then I'll go ahead and I'll cut it down to 50%. I definitely won't add the home care waiver. I won't bolster the home care at all. Okay. All right. So kind of wrap it up here. Let me go through some of these riders here and we'll get you guys done. Shared care, survivorship, joint waiver, and security. What do we kind of write on these things if we have something on them? Well, bear with me, folks, here. I'm going to try to find a slide. We have a slide on this, I'm sure. Okay, here we go. Again, you'll notice with the secure, not available, shared care, security, not available. If I can't say it enough, just go with the custom solutions. That way you have everything available to you. If you don't have to sell it, you can take it out, but you have access to it. That way you only have to learn one plan. Don't worry about learning 2 different plans. Just know that the custom solutions offers everything that Mutual Omaha offers in the long-term care arena. So, okay, let me go through these quickly. Shared care. What that does, again, I'll show you where these are on the software again too. They're all right here. Shared care, survivorship, joint waiver, and spousal security benefit. Okay. Shared care more or less says, okay, we both have a 2-year benefit, husband and wife. So we're both looking at a pot of money of, what we do here, 100,000 each. Okay, shared care says that if my wife uses up her entire pot of money, she can use some of mine. So it shares that pot of money. Upon one of your deaths, the other spouse inherits the unused amount of that account. So dad dies in his sleep, never needed it. She now has a $200,000 pot of money. She inherits his pot. So it's a shared, they can use each other's benefit. Okay. Security, how much that costs, by the way, when I share things? It's about 15 to 20% load. Not that big of a deal, but some people really like the idea of having to share. They're worried about being not quite enough coverage. So when you have people that are price conscious, instead of doing a $200,000 pot of money each, that's $5,000. I'm trying to get by with a lesser premium here. So I'm going to go $100,000, but tell them, if it does run out, we can share it, right? We can put a little share on there for $500, and that way, okay, so it's not a bad option. Survivorship, I almost sell, in this couple, I would sell survivorship to them. What survivorship does is it says, upon one of your deaths, the other person has a paid up policy. So that's kind of a nice deal, especially when you have to see the staggered ages here. We assume they're not going to die together in a car accident, right? So one's going to die before, Joe's probably going to go before Carol. In which case, 10 years from now, 12 years from now, 20 years from now, Joe dies, Carol's policy is paid up. Now her benefits will continue to inflate. And if she had shared care, she's going to inherit his 100,000. So now that 200,000 that's already grown for 20 years is probably at 400,000. It's going to continue to inflate. She just doesn't pay premiums anymore. So her policy becomes paid up. I do, and the load on that, you'll notice, isn't very much. It's about $400 a year. So I do feel like that's a benefit that's worth it, especially if you see a big stagger in age. If it's like 61 and 53 or something, then I almost always put it in there, or because I do assume that older one's going to go first, and then that person has a paid up policy, and that does sell well when you see, like, sometimes spouses want to make sure the other spouse is taken care of if they are older. It's pretty common out there. I'd like to talk about that survivorship benefit. It's a nice one to sell, and most people will kind of agree with it. And I do believe in the benefit because one's going to die before the other one, and how nice it to have a paid up policy. Okay, joint waiver premium, pretty basic here. This just says that built into these long-term care plans, the long-term care plan for Mutual Omaha and most plans out there, when you go on claim, you don't pay your premium anymore. It's called it's a built-in waiver of premium when you go on claim. What joint waiver does is it says both husband and wife are both going to have their premiums waived. So, you know, and it's a very small load. It's like $100 annually. I don't mind putting that in there either. So when either one of them go on claim, they don't pay their bill anymore. Spouse security. Now this benefit here, the spouse security benefit, this is one where, and as an agent, this would happen to me. I would walk into a house and there's a wheelchair ramp going into the house. You know, you open the door and there's a walker sitting right there. There's a wheelchair there. You know, maybe there's some oxygen, in the corner. So you know what's going on here. Mom's already taken care. Carol's already taken care of Joe, and quite frankly, Carol's worn out. She calls a long-term care agent because she wants to buy a policy for Joe because she doesn't know how much longer she can do this. Well, we call these the one-leggers. They waited too long. We can't get insurance for Joe. He's already in a wheelchair, right? So one thing you can do, the spouse security benefit, because right now Joe is living in that house because Carol's living with him. Without her there, he can't, get out of the house. He can't bathe himself. He would be in a facility, barring having Carol taking care of him. So what if something happens to Carol? She has a stroke, ends up in a nursing home. Well, where's Joe going? He's going to nursing home as well. Maybe she recovers, maybe she doesn't. But the point is, for now, so that's a double whammy. So what we can do is we can put the security benefit on her. So, and that's a pretty big load. It's 60% load. So in that situation, Carol's not going to qualify, right? So let me show you how that works out. So let's just say, for example, Carol's 55. She's married, one insurer, but she's the only one applying now. So she's 55, and because he's not going to qualify, he's in a wheelchair, we're just buying coverage for Carol at 55. So her premium is $2,200. If I put her premium was $1,815. If I put the security benefit on here, that gets me 60% of what the monthly benefit is in cash. So if she goes on claim, first day she gets $2,400 on top of the $4,000 she would normally be getting, that she can do anything she wants with. So she could pay then to have a home health care aide or professional nurse or whatever, go out to her husband's house 7 days a week. So what the spouse security benefit does is it puts extra money on the insurable spouse, so that then in the case of going on claim, she has extra money that can be used to take care of the spouse that she's already taken care of. I hope I explained that clearly. It's 60% more money, but you get 60% more benefit, and it's all cash. So all we're doing is we're stacking the benefit, so the well spouse gets more money. So in case they go on claim, it's that one-legger scenario that maybe both of them don't enter the facility. Let me go back to 60 and 55, married, both insured. Okay. All right. So lastly here, I want to talk about known forfeiture, 200% professional. Now look at the annual premium here. It's pretty low, right? If I want to put professional home health care on here, it puts next to nothing on it. Look at it, $90 annually. So that $90. So what that does is that's going to put my professional amount, now instead of having a $4,000 a month benefit, I'm going to have an $8,000 a month benefit. Where I like to show that, by the way, this is another part of, when I'm selling, folks, when I bring the software with me on my computer, I join computer screens. I'm always using this preview button. So I'm going to tell them, okay, here's my ultimate inflation options. So this is what I show people. Let me make this bigger so you guys can see this. Ooh, okay. So this is basically the benefits. So I have a $100,000 benefit, right? If I use cash, I have a $4,000 monthly. So remember how much, how long. This is set up with a $100,000 pot of money at $4,000 a month. So that means the cash benefit, remember, is 25%, $1,000 per day. That comes first day. That would last me for 8 years if I use the cash. But if I'm in the facility, I have $4,000 a month for nursing home, $4,000 for assisted living, and $4,000 for home health care. But if I need a professional, maybe it's just not for basic care to help me with bathing, eating, dressing. I need an audiologist, an RN, an LPN, someone to actually do some physical therapy at my house. Professionals are a lot more money. So now I have access to up to $8,000 a month for professional care. So you can see where that looks nice on paper. And by the way, I do use this page to go through whenever I quote someone. I'll go ahead and bring this page up, so because this kind of really walks them through kind of nice. It says, like, here's your money, here's your policy limit, here's your cash option, here's what you get if you go to nursing home, assisted living. So I really feel like this is a strong page to show people. I saw this page a lot. So that's in the software. You just hit the preview button up here and do that. So, okay, that's professional. And the reason I like that $8,000 a month shows strong. So I tell people, look, with the home health care waiver, with the professional care, with the fact that you have cash, that you can have an option to take cash or reimbursement, you can switch back and forth. This has the strongest home care package of anything out there. Okay. So, and I do believe in that. That's what I think sells long-term care is giving people choice and independence, keep them out of the nursing home. Okay, last benefits here. We have a return of premium rider. So if I die in my sleep and never need this before I'm 65, you see it's very inexpensive to add that, right? Annually here, what did that add? The totals here. Of course, these people are 60 and 55, but if they're nervous about that, for $40, I can add that, so then if I die before I'm 65 in my sleep, now what if I want all of it back? Less claims, of course. Well, then it's about $1,000 more. So if I die in my sleep 23 years from now, they're going to refund all this money I ever paid in back to me for $4,000, for basically an extra $1,000. Some people like that, the use it or lose it factor. A third one here is 3 times monthly benefit. So this one it's going to do is going to say, look, I'll give you $4,000 times 3, $12,000 back if you die in your sleep and never need this. So, look what was low before. It was $3,000. So in other words, you're going to give me and my wife each get a $12,000 burial fund for $200 annually, $100 a year. So $8 a month, I get a $12,000 burial. Where else are you finding that, right? So this is really underused, but pretty small load. So those are your return premium options. Lastly, if you're an employer, if you are an agent, producer, you get 5% off your premiums for being a pro. If you have an association, you can call the marketing office to have an association set up, or if you're working with an employer group, you can't do both. It's a 5% discount for all 3 of these. So if you do have an association you think you can work, or an employer group, you need a minimum of 5 applications. That's it. No bells or whistles. You can get a 5% discount, or if you're an agent. So that's all I really have. Let me go to the end of this thing. I know it's about 40 minutes. Yeah. Okay. This slide, looks like this ends with the power of inflation buy-up, which I did talk about. That is a strong benefit. If I don't want to sell 3% because it's so expensive, it's nice to be able to do that and say, I'm going to lower this and I can always increase it later. Get that premium down to something they can afford. Some coverage is better than nothing. All right. So this was kind of a slash sales and product and software. So I hope it was helpful for you folks. I want to thank you guys for coming on board today. Spend a little time with us. If you do have a case you're working on, call the marketing office. We're happy to help. We're here to help you. Our phone number is 800-842-7799. Since I don't have a screen with it on there, I'm going to say it again. 800-842-7799. If you need us, give us a call. We'll help you with plan design. We'll help you with quoting. We'll get you apps, brochures. Like I tell my agents who call me, I'll make you look real good. Okay, we'll get you set up. We'll get you ready to make that sale. So with that, thanks a lot for coming on board, folks, and good luck selling out there.
Check out our website, goldencareagent.com, or give us a call at 800-842-7799. check out our website, GoldenCareAgent.com, or give us a call at 800-842-7799.